Good morning and welcome everyone. You are all very welcome to our webinar focused this morning on retirement planning for business owners and senior professionals. My name is Wendy McKeown. I'm Head of Financial Planning at Unio Wealth Management and I'm delighted to be your host this morning. I'm joined by my colleagues Andy Dixon, Head of Independent Wealth and Family Office at Unio, and Yvonne Clinton, a Senior Financial Planner within the Unio Advisory Team. This morning's session is intended to provide you with some key insights on topical areas around retirement planning and those that are of relevance particularly to you. Before we get going, a little housekeeping. This morning's webinar will run for 45 minutes and will include a couple of minutes at the end for any questions. Please use the question box that you'll find on the right-hand side of the screen if there is anything that you would like to ask. And if we don't get to your question during the call today, we will respond to you promptly after the webinar. So today's agenda, put simply, will focus on making the most of your pension options, understanding the key opportunities that are available to you, and with the right guidance, how to use them wisely. Yvonne's going to firstly take us through Unio's approach to retirement advice and our financial planning-led delivery. And then she's going to cover an update on the current pensions landscape and some recent changes. We will then move on to talk a little bit about some of the pension options available and how to make best use of these depending on your own personal circumstances. After examining some ideas around business exit planning, Andy's going to follow up with a case study that looks at Unio's approach in practice and how tailored advice can assist a smooth transition into retirement. Lastly, before I hand over to Yvonne and Andy and we get into the good stuff, I just want to finish up with a little bit of background on Unio for anyone that might not already be familiar with us. Unio Wealth Management was formed through the amalgamation of several established Irish wealth management companies, some going back over 30 years, and with the backing of the Canadian company Great West Life Co, who also own Irish Life. Unio currently employs 300 staff across our offices in Dublin, Cork, Limerick and Galway, and we have 14 billion in assets under management. Okay, without further ado, I will hand you over to Yvonne.
Thanks for the introduction there, Wendy, and good morning, everybody. So I'm just going to talk through, first of all, Unio's approach to financial planning, which is very much a holistic approach. We look to identify and understand what our clients' goals are, and then to understand the roles that their different assets are going to play in their lives whenever we take this financial planning-led approach to wealth management. One of the tools that we use is our hierarchy of financial needs. We use this to both understand and prioritize our clients' goals. You might recognize some of these goals as they drop in here as being things that you would like to achieve for you and your family, or perhaps milestones that you have already hit in life. The bottom section, guarding, this represents the basic building blocks of any financial plan. This is the foundation that all other goals are built on. These goals are about making sure that you and your family's immediate financial future is secure no matter what happens. I imagine at this stage of life, most of you will have these pretty well covered and be working towards goals that are farther up the pyramid, so I'm just going to focus on those for now. Where you're probably sitting is in those top two sections, growing and guiding. Growing is where people realistically spend a great deal of their working life. This is about planning for retirement by becoming debt-free, by investing regularly, personally or through a pension, and for business owners, and I know we have a good few business owners on the call today, looking to exit your business. At this stage of life, you might also be starting to think about some of the goals in the guiding section at the top of the pyramid, particularly maybe estate planning, lifetime gifting if you're looking to help your children get on the property ladder, and perhaps planning some travel for all that well-earned free time you're going to have in retirement. There can realistically be a lot of overlap between the guiding and the growing, particularly for business owners who might be looking to pass on a family business to the next generation. But the assets that are used for each of these is quite different. So as financial planners, we see our role as being to guide our clients to understand and articulate their goals. If not, how can we really issue them with any form of recommendation as their wealth manager? Because how can we know whether this particular investment is suitable if we don't know what the goal of the client is? It doesn't matter how successful the investment is. If it hasn't helped the client to achieve their goals, we can't really call that much of a success. So what we want to do is recommend how our clients can go about achieving their goals in the most efficient and effective manner, and investment being just one part of that. The other tool that we use in our financial planning is our wealth allocation framework, which allocates the client's existing asset base to the different goal types. So we understand how you're currently positioned in terms of achieving those goals. The most basic of security assets, cash and family home, sit in the guarding section. Where a lot of assets will sit for clients is the growing section. This is pensions and well-diversified investments that can be relied upon to provide an income in retirement. And then out on the right, under guiding, we typically see assets that might be a little bit more concentrated in nature, maybe a little bit illiquid. And these factors may make it quite a little bit more high risk relative to the growing, something that maybe cannot be relied upon in the same way to generate an ongoing income in retirement, but may at some point in the future provide a significant capital or income current cash inflow. Where we do encounter significant assets under that guiding section, it's typically because the person is a business owner, so they've got a business sitting there, an asset that's potentially quite illiquid but could be sold for a significant sum in the future, or because they are maybe a high-ranking professional in some of the multinationals that maybe has a share package as part of their remuneration and has built up a significant shareholding in their employer. I know we've got a couple of people in that bracket on the call today as well. So as financial planners, what we might look to do is to reallocate and diversify those assets and move them into the middle growing bucket so that they can be, coordinated plan to bring them into a form where they can be relied upon to provide that replacement income in retirement. So that might mean selling down a share portfolio over time or looking to extract cash from the business, which I'll talk a little bit more about later on. And just to touch, while I have you, just to touch on the rest of the financial planning process we do use an interactive cash flow modeling tool with our clients. So in a meeting, we can model out whatever scenarios that client might like to see for what their future might look like, with a focus on what future income and expenditure and what the future asset base might look like. And then we produce a report for that client to bring home, to review in their own time, and to then maybe show their family and ultimately bring back to us to update, because it's a living document and an ongoing engagement that we perform with our clients over time as their circumstances change. So that's just an introduction to our financial planning, and I might just hand back to you, Wendy, there.
Thanks, Yvonne. It really is a fantastic way to approach retirement planning. I suppose not to look at it in isolation, but instead to look at the bigger picture alongside sort of lifestyle aspirations and your goals, and that kind of cash flow modeling really supports being able to look at that, I suppose, so that you can kind of tease out what you're going to do when working no longer fills the days, and how your financial plan is going to support that. Yvonne, could I ask you now maybe to take us through some of the recent changes across the pensions landscape and how these might be of particular relevance to those listening into the call today?
Yes, thanks, Wendy. I'll try to make this as interesting as possible for everybody. We've had two main changes to the world of pensions in the last year. So the first one is the standard fund threshold is increasing, and the second is the introduction of auto-enrollment. So to start with the standard fund threshold, and what is the standard fund threshold? The standard fund threshold is a limit to what the total amount of pensions that an individual can accrue in their lifetimes tax efficiently. It currently stands at €2 million. So if somebody has accesses pensions valued at more than €2 million, they will be taxed at 40% on the amount in excess of 2 million. Now, it's been fixed at that €2 million since 2014, but as announced in last year's budget, from the 1st of January, it will be increased to 2.2 million, and it will then increase at 200,000 each year until 2029 when it reaches 2.8 million. And from there on, it will be linked to inflation. So it will continue to increase at a rate determined by inflation. So this is something we were very, very delighted to see when it came in last year. It was announced last year, because the standard fund threshold was fixed at €2 million since 2014. We've obviously seen significant wage and price inflation since then, but there hasn't been an increase to the limit on pensions to allow people to save more to fund for the fact that they will have much higher prices in retirement, etc. So very, very welcome measure. What's not changing with the standard fund threshold is that there's no change to the amount of lump sum that can be taken tax efficiently. Currently, it tops out at €500,000, which is 25% of the standard fund threshold. It's going to be fixed at 500,000. It's not going to increase again to 25% of 2.8 million in 2029. There's also going to be no change to the amount of offset available. So you may have had it explained to you before that you can offset the tax you pay on your lump sum with the first bit of chargeable excess tax. That regime won't be changing either. So the relevance for you is anyone, of course, that might be around the standard fund threshold. There's potentially a little bit of opportunity there. And I thought it would be useful to talk through that with an example of a client we've been talking with recently. The complication for a lot of people is that they may have already accessed some pensions in the past over the last 11 years. So I thought it would be useful to explain the potential for future funding with an example around that. So this client, very typical of clients we've been talking to over the last number of weeks, months, is Richard. He is a 60-year-old professional services consultant. So he spent his 40-year career working in professional services, and he built up €2 million of pensions over that time. He accessed €1 million of them back in 2023 because he wanted to clear off his mortgage using the lump sum, and he left the other €1 million untouched. Now he has set up his own consultancy company, and he's doing really, really well with that company. And he's heard that the standard fund threshold is going up to 2.8 million. And he says, oh, and he's come in to ask his advisor, can I fund another €800,000 of pension? And while there is an opportunity for Richard to fund, it's unfortunately not as substantial as €800,000 more. So to show the example there below, and this is applicable to anyone that retired benefits between 2014 and 2025. When he retired that €1 million back in 2023, he consumed 50% of the standard fund threshold of €2 million that was prevailing at that date, and he therefore had 50% of it remaining. When the standard fund threshold increases in January to 2.2 million, he will be deemed to be entitled to 50% of that 2.2 million. €1.1 million. So he can, while the standard fund threshold is increased by 200,000, he can only benefit from an increase of 100,000. So if we look out as far as 2029, the standard fund threshold is 2.8. He is entitled to retire another 1.4 million, 50% of that 2.8 of pensions before he hits the standard, he starts incurring chargeable excess tax. So while there is an opportunity there for him to fund more, up to 400,000 more, depending on the growth that he incurs in those pensions in the intervening time period between now and 2029, he isn't able to get a full 800,000 in. And just to reiterate for anyone that may have retired a full 2 million already of pensions, if you have retired 2 million, you've used 100% of the standard fund threshold. So unfortunately, there is no further funding opportunity, no further efficient funding opportunity there. So that's how the standard fund threshold works in terms of if you've retired some pensions already. Realistically, some people will always go over the standard fund threshold, and it's not the end of the world. There are a number of strategies that you can apply to try and manage your exposure to chargeable excess tax if you're in that position, and to maybe minimize your exposure to it as well. What we talk about with clients in particular is, first of all, the option to defer retirement. At the moment, with the standard fund threshold increasing significantly over the next few years, this is a very attractive option for anyone that is only a small bit over the standard fund threshold. They can simply wait to retire their benefits until the standard fund threshold catches up with them, and they're able to access them without incurring any chargeable excess tax. This does, of course, require them to have other assets or income to live off in the meantime. And it is a bit of a balance between the growth of the pension assets with the growth of the SFT, but worth discussing with your financial planner and maybe doing a bit of cash flow modeling on to see if this is feasible for you. Another option is to engage in a phased retirement, which is what was illustrated in the previous slide there with Richard in our case study, which is maybe retiring some of the pensions now and holding on to some of them so that you benefit from some of the increase in the standard fund threshold, but still get your hands on some cash or some income now if that's what you require. If you have pension pots from multiple employments, and I think Andy's going to be talking about this a bit more shortly, but if you have multiple pension pots, you can maybe do this naturally. If not, you may need to use a PRSA structure and then divide that PRSA into as many pots as you need to phase your retirement. The last one I just wanted to mention is probably relevant to a small niche of people on this call, which is those who might have defined benefit pensions. So if you have a defined benefit pension, this is where you're paid a guaranteed income for the rest of your life, and you're going to be over the standard fund threshold. It's important to think about the timing of how you access all your pensions. The chargeable excess tax will always fall on the pension that brings you over the 2 million, typically the last pension accessed. So for a public sector person with a public sector defined benefit, it may be very advantageous to have that last pension be the DB. But for someone who has a private sector defined benefit pension, it may not be so advantageous. So it's important to think about that and plan it with an advisor rather than having it simply be a case that you claim them all as NRA comes up, as your retirement age comes up for each of them, and don't think about where that chargeable excess tax is going to be paid from. And lastly, on pensions, I think it will be remiss of me not to mention auto enrollment. It's going to be a huge change for the business owners on this call coming in from the 1st of January. But it's the goal of auto enrollment is to improve pension coverage and have more people saving into pensions for retirement. And what it's going to mean in practice is that anyone aged between 23 and 60 who is earning more than 20,000 euros a year is going to have to contribute to a pension. Not only are they going to have to contribute, their employer is going to have to contribute, and then that's going to be topped up by the government. So it's going to be a massive change for business owners. Now, there are exemptions there for the self-employed and for people who are already having pensions contributed into. Now, the requirement there is either a personal employee contribution or an employer contribution needs to be recorded on that individual's payslip. If it's not recorded on the payslip, the system, My Future Fund systems, does not know about it, and the employee will be auto-enrolled. So our sister business in employee benefits has had quite a busy time with dealing with their clients. Some business owners are happy to have their staff captured by auto-enrollment. Some business owners are looking to make membership of their pension scheme mandatory. So then all members of the company, all employees will be contributing to it and therefore be exempted from auto-enrollment. Some people are looking to set up pension schemes for the first time, again with mandatory membership, so that they can have their staff engaged and enrolled in that rather than captured by auto-enrollment. There's a lot of different options available, but probably worth thinking about if you haven't already. So a lot to think about there. I've probably thrown a lot of pension-related changes at people there, but I'll hand back to you, Wendy. Thank you very much.
Thanks. I guess while complicated, the SFT change in particular presents a real opportunity for further pension funding for those who've already amassed significant funds and might have the option to push retirement out, or even those who've maybe just partially retired some of their benefits and still have some to go. Turning to Andy now. While proximity to the SFT is something worth exploring further if I go to your funds, approaching that 2 million mark, could you maybe take us through some of the other strategies and maybe the product options that can prove really useful on approach to supporting a kind of efficient retirement?
Yep, thanks, Wendy, and good morning, everyone. Thanks for being with us. Yeah, so I'm going to talk a little bit about the pension product options out there, and specifically focus in on two types of pension plans. So unfortunately, simplicity has never been a feature of the Irish pension system, but I guess having optionality means that then there's scope for us as planners to kind of try and figure out what the best option is for you and how you can maybe take some advantage in terms of the differences in the rules and regulations applying to the various structures. So there are still quite a few different types of pension plans. There are two particular pension products that we're talking to our clients about a lot at the moment, and that is an occupational pension scheme, otherwise known as a master trust, and a PRSA. Okay, so due to some of those changes in pensions legislation that Yvonne has talked to earlier, we are currently in the process of winding up all of our clients' one member schemes. So that would be small self-administered pension schemes and executive pension plans. Okay, and in the course of that process, the two types of pension plans that we're using to replace or receive those transfers would be the Master Trust and the PRSA. So I'm going to talk through those, some of the kind of features and the differences between the two. And then I'll also talk a little bit about what we call retained benefits. So retained benefit is simply a pension pot that you've accumulated from a previous employment. Okay, so there are some interesting conversations that we have with clients in relation to their retained benefits, and I think it's probably worth just touching on that as well. Okay. So, Master Trusts versus PRSAs. As I said, all one-member schemes are in the process of being wound up, okay? And we then have to make the decision in conjunction with the client as to what type of structure receives that fund transfer, and also what we use for funding going forward, okay? So, really those two, the two, as I said, the two types of plans that we're using would be what's called a Master Trust, which is just an employer-sponsored occupational pension scheme, and a PRSA, which is typically set up as a standalone contract between the individual and the PRSA provider. Okay, so in terms of future funding, one key difference between the two is the limits applicable to how much the company typically can contribute on behalf of the business owner. Okay, so because a Master Trust is with a couple of small differences, but it's more or less a replacement for the executive pension plan or the SAP. In a Master Trust, you would still use the old service and salary funding calculation. Okay, so to determine how much the company can contribute, we would look back at your level of salary, and then the length of time you've been drawing that salary from the company, and there's then a calculation that we run which will let us know how much the company can contribute. In a PRSA, the maximum annual employer contribution that can be made is restricted to 100% of the client's current salary. Okay, so straight away we'll often find that, particularly where the client is keeping their salary low, as some business owners do, it's much more advantageous to use a Master Trust for future funding than to use a PRSA. Okay, another difference between the two is in relation to investment restrictions. Okay, so because a Master Trust is an occupational pension scheme and the legislation around permissible investments has changed recently, the maximum that can be invested within that fund is 49% of it invested in what they term unregulated investments. Sorry. So the most straightforward and common example of an unregulated investment would be a client who holds a direct property within a small self-administered scheme. You don't have those same restrictions in a PRSA. So in a PRSA, you can still invest in a diversified multi-asset portfolio. You can still have more than 50%, say, invested in direct property if you're using what's called a self-administered PRSA. Okay, so just in terms of some of the sort of basic rules around the two structures, there are some clear differences. And then to move on to maybe some of the features that make them interesting from a planning perspective, there are also some differences in relation to accessing the funds and in the death benefit treatment. Okay, and this really is what's sort of driving a lot of the discussions we're having with clients at the moment. So in terms of the earliest access age, if you have a Master Trust and you've left that employment and you're no longer connected to it, you can access the fund from age 50. So you can take your lump sum at age 50 and set up your post-retirement fund, even if you're working in another employment. In contrast, if you have a PRSA, then you can access it from age 50, but you must not be working either for that company or anywhere else. Okay, so it's essentially a full retirement. All right, so more flexibility in terms of early access in the Master Trust than in a PRSA. On the flip side of the coin, in terms of latest access age, you must access a Master Trust before age 70. Okay, so that's the latest stage at which you can access the fund. Whereas with a PRSA, you can actually defer that a further 5 years out till age 75. Okay, so that becomes quite useful where a client, for example, might not want to either trigger chargeable excess tax. You can split the PRSA, take some of it now and some of it later. Or perhaps if the client doesn't want to draw down the income from the post-retirement fund and pay income tax on that, then again, if you want to defer taking benefits for another 5 years, the PRSA becomes quite a useful planning tool. Another really important distinction between the two is the death benefit treatment. Okay, so in a master trust, the old sort of traditional rules apply. The maximum lump sum death benefit is 4 times salary, and any balance or any residual fund in the pension must be used to either invest in an ARF, which is a post-retirement fund, or buy an annuity, which pays you, would pay your dependents an annual pension for life. Okay. Comparatively speaking, if you look at the PRSA, if anything happens to you while you have a PRSA, even if you're still funding, or if you stop funding between, say, 60 and 75, if you're deferring drawing down, in the event of death, the full fund is then payable to the estate. Okay, so it's payable as cash. It's no longer within any sort of pension structure, and there's no other restrictions applying. Basically, it's just distributed in accordance with your will, and then inheritance tax we pay depending on who inherits. So it's a far more advantageous death benefit treatment in a PRSA, typically speaking, than in a master trust. Okay, so as a sort of general rule, and there are exceptions, a master trust will give you more scope for funding, but the PRSA is often a lot more useful in terms of a planning tool. Okay, and what that the situation that then sort of leads to is that we are often finding ourselves now recommending both structures to clients who are winding up either executive pensions or SAPs. Okay, so it's becoming quite common where like simplicity is obviously very, very welcome, but if there are clear benefits one way or the other between the two structures, we will often recommend that the client uses both. Okay. So 2 examples of that are shown on the slide. One might be where there are significant considerations around the death benefit. Okay, so that might be ill health potentially, or maybe a situation where the fund accumulated is well in excess of 4 times salary. And if that's the case, it often makes sense to transfer the accumulated fund into a PRSA and thereby protect the fund in the event of death, and then set up a separate master trust and use that for ongoing funding, because potentially the limits would be a lot more generous in a master trust. Okay. Another scenario would be where a client initially deemed that the limit on a PRSA, i.e. 100% of salary, would be more than enough in terms of what they intend to contribute going forward. So there's an existing PRSA in place. But then the client could have a very good year in the business, and all of a sudden there are additional funds that need to be contributed to the pension plan. We can then subsequently set up a master trust just to accept that large single contribution. We would need to look at the tax relief treatment and talk the client through that. But again, that's another scenario where you might have a PRSA in place and then a new master trust running alongside it. Okay, so as I say, it's becoming quite common where we'll actually use both structures for clients. One last piece of advice, and that is, if you do have an executive pension plan, then the providers will be writing out to you, if they haven't already, with a default option, essentially. And that option is just to default across into the master trust. Okay, that might well be the best option for you, but there will be circumstances where it's not. Okay, so any one of these areas I've touched on earlier in relation to access age or the death benefit considerations may be relevant to you. So we would say it's really important, don't just go with the default, get advice, and we'd be happy to sort of talk you through what are the key considerations for you and which of the 2 structures would be most suitable. So that's it from me, Wendy. Back to you.
Okay, thanks, Andy. So still plenty of opportunity to tax efficiently fund your pension. And I guess it's important to structure both the funding and then the benefits that you've already built up in a way that you can draw on them that supports your, your individual retirement income needs. The way different pension arrangements pay out on death is also something that's really important to keep in mind, which is interesting as well. I don't know, Andy, were you also going to cover a little bit there just on, retained benefits, maybe if you could just take us through that?
Yeah. So obviously, when it comes to the wind up of those schemes, we're really looking at future funding, and as I say, suitable structure to replace what they have at the moment. But just to go back to some of the areas that Yvonne was talking about earlier, in terms of us taking clients through a pretty in-depth financial planning process, it is important that we look at retained benefits also. So by retained benefits, what I mean are any pension pots that you've accumulated from previous employment. So there's often, I wouldn't necessarily say a knee-jerk sort of tendency maybe to try and combine these into one pot. As I said, simplicity is often quite welcome, when it comes to talking about pension plans. But we do need to consider that quite carefully, because having your pension funds spread across a number of different pots does give you flexibility. Okay, so you can decide to draw down on certain pots at different times. Those same death benefit treatments that I talked about earlier also apply to retained benefits. So very often a retained benefit, you might have the full fund payable to the estate in the event of death, whereas if we were to combine that with a master trust, for example, then you're back into the situation where 4 times salary is the cap. And then I think finally, it's probably important to look at it holistically in terms of the investment strategy. So if you're funding into a new pension and you might have maybe 10 or 15 years to go to the intended date at which you're going to draw benefits, and you're paying in a regular premium, you can afford to take on more investment risk, Whereas if you have a retained benefit, a personal retirement bond, or a similar structure from a previous employment, you might decide to draw that down immediately or draw it down in maybe 12 months or 24 months. In which case, you might well be better considering a lower risk portfolio just to reduce that volatility and potentially protect your lump sum. So yeah, we're talking when it comes to the wind up of EPPs and SAPs about PRSAs versus master trusts, but in the context of that holistic financial planning, building out the cash flow and network projections, it's important that we also take into account your previous pension pots.
Yeah, so the message there really, Andy, is don't rush to amalgamate everything. It's better to talk through with your advisor and see whether there's some opportunity there for sort of clever planning around having these sort of separate pots of retained benefits. Yvonne, just moving on there, business owners sometimes have a heavy reliance on the sale of their business for funding their retirement. Could you maybe talk through some of the other effective cash extraction methods and some of the reliefs that are available on the sale of somebody's business?
Yes, thanks, Wendy. So yeah, like it can be very common among business owners that the goal is to build a business up and sell it, but we think it's important to look at how you can extract cash as you go. And the main way to look at extracting cash as you go in an efficient manner is through pension funding. And the benefit of pension funding is that it builds up funds from the business, transfers them into your personal name, and these funds will accumulate over time. The benefit of this is that a pot of funds is built up, and that they are completely separate to the business. So if anything happens with the business was to fold, those funds are still in your own personal name for your use. You're not relying on the future valuation of that business. These funds can accumulate over time, and then it's important to note that it's very tax efficient. From the point of view of the company, they get tax relief on the contributions, and the business owner will benefit from tax-free growth within the pension structure on those funds. Then at retirement, the pensioner, the business owner, can benefit from a tax-efficient lump sum and an ongoing income in retirement. The real benefit of this is that it means that you don't necessarily have to focus on selling the business on the day you maybe want to retire to be able to fund that retirement. It might give you the flexibility to have a pension asset there that you can draw down and live off while you wait for a more favorable environment or climate to sell your business in, and to make sure you get a fair valuation for it, rather than having to maybe rush to sell your business and extract to realize cash so that you can step back from the business at a time when maybe the industry isn't performing well. It's a difficult time for the industry, or even for the country as a whole. If you can imagine trying to sell a business during COVID, wouldn't have gotten a very fair valuation for it. However, a business sale is still going to be a very important part of any business owner's financial plan. And within a business sale, there is going to be exposure to capital gains tax for the business owner. However, there are reliefs potentially available for this. As I noted, it is a bit of a point in time valuation for that. If you could actually, sorry, go back one slide there. So just to go back there, there is potentially a point in time valuation on that business sale. So again, very sensitive to the whims of maybe what's going on in the industry, but it is a very efficient way of getting cash out. Then on the redundancy payment, this is another one that people use, and it's often again available at point of exit, whereby the business owner may be paid a redundancy payment by the business. This represents a cash lump sum, again, extracted from the business, some or all of which may be tax-free in the hands of the business owner, so very efficient. Now, I did mention those reliefs that may be available from capital gains tax, and I'll just go through them now, maybe in a little bit more detail on the next slide. So the first relief there from capital gains tax is entrepreneur relief. For the business owner, this means that they can pay a 10% rate of capital gains tax on the first €1 million of gains they make from selling a business or transferring a business in their lifetime. So if you compare that to the standard rate of capital gains tax of 33%, that's a 23% saving, which is €230,000 per person. And there's also retirement relief, which can actually reduce or even eliminate capital gains tax entirely. So these are two really, really valuable reliefs, but they do have quite a lot of qualifying conditions attached to them, both on the business in terms of how it's structured and what assets it has, and on the individual themselves. So we always talk to our clients about these because we say, well, we're not tax advisors, but it's really important you talk to your tax advisor about this well in advance of your planned exit date, because we want you to maximize how much you get for your business after tax. You know, we're trying to plan the rest of someone's life and plan a good retirement for them. Having an additional €230,000, to use the example of entrepreneur relief there, in the bank to live that retirement with is going to make it a lot easier to give someone all the goals that they want to achieve in retirement. So it's really important to talk well in advance to plan this and make sure you qualify. The other one I've mentioned there on the right just is business relief. This is a relief from capital acquisitions tax, which you may also refer to colloquially as inheritance tax or gift tax. This is applicable on the cohort of business owners that are looking to pass the family business on to the next generation, i.e. to give the business to their children, for example. And if you hand over a business to a child, it's a very valuable asset, and it's likely to be valued in excess of the amount that they can receive tax-free from their parents in their lifetime before incurring capital acquisitions tax. However, this relief will reduce the taxable value of that business by 90%, which probably will, in most circumstances, bring it within the scope of that tax-free allowance. So again, a very valuable relief, just really important to talk to tax advisors and make sure you can qualify for it. So that's just a small bit on the reliefs. We're always happy to talk to people about them in a bit more detail, but I'll hand back to you for now, Wendy.
Thanks, Yvonne. And I suppose you've called it out really well there already, but it's really important that you consult with your accountant and your tax advisors in conjunction with your financial advisor in plenty of time when planning business exit and ultimately your retirement, just to make sure that you can really maximise on those reliefs available and the different kind of planning opportunities available as well. So putting all of this into practice, Andy, could you maybe run through an example for us?
Yeah, sure. Thanks, Wendy. So yeah, we thought it might just be useful to just take you through a typical case study of the the types of, I guess, the initial discussions, and then the work that we do in the process that we take clients through to sort of incorporate that retirement planning into the more holistic financial plan. So we have a typical case here where we have two clients, aged 57 and 61, married, who are both shareholding directors of their own company, which they've had since 2009, and 3 adult children. So this is quite an interesting scenario where one of the clients is keen to retire immediately, whereas the other client wants to keep working. The business does have considerable value, but there's no intention to sell in the immediate term. So there are 2 executive pension plans in place, one worth 745,000 and the other worth 239,000. Okay, so this discussion, I guess, arises out of the need to wind up 2 executive pension plans, and and then I guess develops into a broader retirement planning discussion. No other preserved benefits for these clients. They do have personal cash reserves outside the company. Okay. So I guess from the point of view of the specifics in relation to their financial needs, it's pretty straightforward as to the advice that they're looking for. Okay. So it's obviously tax efficient retirement planning advice, maybe more technical pension advice related to the standard fund threshold, and then also managing their own limits in relation to the maximum amount that the company could contribute on their behalf. This would be a scenario where one client's looking to draw down at different times the other client, so that flexible sort of phased drawdown comes into it. If we're looking at things holistically, then we need to look at the personal money as well as the pension portfolios. And then finally, with obviously a sizable asset base like this, we do need to consider the longer term. Once we've established that their immediate financial needs are met and that we can do what they want to do from a retirement planning perspective, we do then also need to look at the longer term estate planning side of things as well. Okay, so just to maybe talk through the process then again in terms of the solutions that we implemented. Essentially, when we're working through that cash flow modeling exercise, just out of pure necessity, we cannot just include the retirement plans, the two pension plans that are set up. Okay, so this is one of the reasons why we'd encourage clients to go through the process, is that it means that we have to gather all the information in relation to their own objectives, lifestyle objectives, property sales in the future, when and how they want to retire, and what retirement actually looks like in terms of maybe, not a complete retirement, maybe sort of a gradual phase down in terms of their work. So the first step in the approach is to go through a pretty detailed cash flow modeling exercise. That being said, clearly the pension structures are pretty key tools, I guess, in the financial plan here. So we need to look at them in some detail. So when we worked this through, there was the capacity in terms of funding from the company to reach, or projected to reach, that standard fund threshold, the increased threshold of 2.8 million by age 65. Okay, because the client's once the client gets over 60, then essentially there's complete flexibility. As long as they want to, they can stop and draw down the pension. So we can target fund that 2.8 million without necessarily locking the client or the business into doing that. Mary, on the other hand, wants to retire straight away. So because we can still avail of the maximum funding calculations, those revenue, service and salary calcs that I referred to earlier, we could use that max funding to make a significant single premium contribution into that executive pension. Okay, so that can be done in the immediate term, significantly boost the pension, maximize the tax-free lump sum, and she can then draw down on that straight away and retire immediately. Okay. In terms of the investment portfolio, then we're obviously looking at three different investment portfolios here. We're looking at the pension portfolio for Tom, which is relatively longer term. We're looking at Mary drawing down her pension benefits nearly immediately, so that single premium will probably be invested in cash, and then we decide what to do with it in the post-retirement fund. But then we'd also need to look at those cash assets outside of the pension structures and come up with a plan as to what they need for the short, medium and longer term, and how that should then be invested also. So I guess by working through that cash flow modeling process and looking at those specific sort of, I guess, product specific areas, we can meet all the shorter and medium term requirements, and we can kind of therefore logically move on to the estate planning piece. Okay, so the cash flow modeling will show that their projected residual net worth in their estate, and obviously then the inheritance tax liability that they're likely to leave behind. So there are a number of ways in which we can look to minimize that. So an obvious one is to use the annual small gift exemption and give €3,000 per person to each the kids, the grandkids. We are setting up both Section 72 and Section 73 policies for these clients as well. Okay, so Section 72 is just a life cover policy set up under trust to clear an inheritance tax bill, and the Section 73 is essentially a savings plan to prepare to pay an inheritance tax liability in the future in the event of a gift. Okay, but I guess for a lot of clients who are looking to sell a business that might be worth, you know, multiple millions, there's going to be significant, well, you would hope there's going to be significant interaction with a tax advisor, you know, outside of Unio. So we would often work with external tax advisors to coordinate the planning. So for example, there could be a family partnership set up, or a holding company, or an investment company. And then it's for us to liaise with the tax advisor to make sure that if we're giving advice in terms of, say, investment portfolios within those structures, that the, you know, the tax treatment of those portfolios are sort of thought through and in line with the advice of the tax advisor on the outside. So we just thought that might be interesting to see the sort of development from specific pension questions, I guess, at the outset of this process, and then the way we work through it with clients. And what it just means is a much more sort of holistic, in-depth review of everything they have and their requirements.
Thanks, Andy. Thanks, and thank you, Yvonne. Lots to consider, lots of planning opportunities, and it clearly continues to be important that you know, you check in with your advisors in plenty of time to make sure that you're getting that professional advice around retirement and the longer term financial planning. Before we wrap up, we do have, I think, a little bit of time that we're kind of tight to take a couple of very quick questions. We will make them quick. Firstly, Yvonne, can a business owner set up a one-member PRSA or master trust for any employee? You might have covered that already.
Yeah, I was going to say, in short, yeah. The answer there is yes, they certainly can. We often, that's a very normal thing to do. We would see it done for any employee in the business, maybe a key employee, maybe a family member, like in the case study that Andy just went through there, looking to maximize funding. You could set up a pension for a family member working in the business. Maybe if the business owner themselves are going to be at the SFT or something. So yeah, you certainly can.
Super, thanks. One for you, Andy. What happens to a PRSA after the age of 75? I'm assuming that means where it's not been retired before 75, what happens?
Yeah, thanks, Wendy. Yes, so, well, I suppose the first thing to say is if you are entitled to a lump sum, make sure you take it from the PRSA before age 75. The implications aren't great if you don't. But then after that, it's one of two scenarios, really. The first is the balance. So typically 75% of the fund just stays in the PRSA in what's called a vested PRSA. Or it can be transferred to an approved retirement fund, which is a very similar structure. So the rules in relation to drawing down income from those two structures are the exact same. They're both tax exempt, so of course the investment growth continues to benefit from that sort of environment. But essentially, yeah, one or two things. They'll either stay in the PRSA as a vested PRSA, or you transfer to an approved retirement fund.
Yeah, thanks. Thank you. Yvonne, Andy, I'm conscious of the time, and we promised to get everybody out on time. We still have a few more questions there, but we will get back to those individuals directly as soon as we can after the session. That leaves me to say thank you so much for joining us this morning. We are very appreciative of the fact that this can be a kind of complicated topic. We are here to help, so do feel free to reach out and get in touch. You may already have a Unio advisor that you're working with, but if not, we have a dedicated pensions webpage. That's unio.ie/2025, where you can book a consultation with one of our advisory team who will be happy to assist. We will share that link and a recording of this webinar with all the attendees after the event. Yvonne, Andy, thank you for sharing your expertise, and thank you for attending today. We look forward to being in touch with you again soon, and until then, take care and goodbye for now.